September 15th, 2008. Wall Street woke up to a sentence that sounded impossible. Lehman Brothers was bankrupt. A 158-year-old investment bank, one of the names that made global finance feel untouchable, had collapsed. But Lehman was not the beginning. Lehman was the moment the whole world finally saw the disease. Within hours, the panic moved faster than anyone could explain it. Banks stopped trusting banks. Investors stopped trusting prices. Lenders stopped trusting collateral. The system that was supposed to move money around the world suddenly froze like a machine with sand poured into its gears. Businesses that had never touched a subprime mortgage began wondering if they could make payroll. Retirees watched retirement accounts shrink. Families who thought home ownership was safe discovered that paper wealth could evaporate faster than smoke. This was not just a market crash, it was a trust crash. The official story sounded complicated. Mortgage-backed securities, CDOs, credit default swaps, repo markets, liquidity freezes. But underneath the jargon was something simple. Wall Street built a profit machine where everyone got paid to pass risk to the next person. The question is not only, how did the crisis happen? The darker question is, why did so many intelligent people keep feeding a machine they knew was getting dangerous? That is where the story begins, not with Lehman, but with cheap money. After the dot-com bubble burst and the shock of September 11th, the American economy looked fragile. The Federal Reserve wanted to keep the engine running, so interest rates were cut aggressively and borrowing became cheaper than it had been in years. Cheap money changes behavior. Families feel richer, investors feel braver, builders build faster, banks lend more, and when interest rates fall low enough, caution begins to look stupid because everyone around you seems to be making money. Housing became the perfect obsession. It was emotional, familiar, political, and easy to sell. A home was not just shelter anymore. It was marketed as safety, wealth, status, retirement planning, and the one investment that supposedly could never fail. Then the dangerous belief took over. Housing prices do not fall nationwide. Once people accepted that sentence, discipline started dying. Borrowers stretched, lenders loosened. Investors stopped asking hard questions. The market was no longer pricing homes. It was pricing fantasy. Between the late 1990s and 2006, home prices surged dramatically. People who already owned houses felt like geniuses. People who did not own houses felt like they were falling behind. That fear of missing out became rocket fuel for bad decisions. At first, lenders gave mortgages to people who could probably repay. Good credit, stable income, real documentation. But once the safe borrowers were used up, the machine faced a problem. Wall Street still wanted more mortgages to package and sell, so lending standards started falling, not all at once. Slowly enough for everyone to pretend it was normal. A little less documentation, a little weaker credit, a little more optimism. The machine did not need perfect borrowers anymore. It needed volume. Subprime loans exploded because they solved a problem for the industry. They gave lenders more loans to originate, Wall Street more raw material, rating agencies more products to rate, and investors more yield to chase. The borrower became the weakest person in the chain. Some mortgages looked affordable only because the first payments were artificially low. The danger came later, when adjustable rates reset higher. Borrowers were handed loans that looked like keys but behaved like timers. Then came the absurd loans. No income, no job, no assets. Ninja loans. In a healthy system, that would have been a warning siren. In the bubble, it was treated like financial innovation. Why would lenders make loans they knew might fail? Because the lender was no longer the final owner of the risk. The loan could be made, sold, and forgotten. That one incentive shift helped poison the whole system. This is where securitization enters. In the old model, a bank held your mortgage. If you failed, the bank felt the pain. In the new model, mortgages were shipped to Wall Street like raw meat entering a factory. Wall Street bundled thousands of mortgages together into mortgage-backed securities. The sales pitch was elegant. One loan might default, but thousands of loans together should be safer. It sounded mathematical. It sounded diversified. It sounded responsible. But diversification only works when the risks do not all move together. If the entire housing market is inflated by the same cheap money, the same loose lending, and the same belief system, then thousands of loans can fail together. To make the products easier to sell, Wall Street sliced them into layers called tranches. The top slices were labeled safer. The bottom slices took the first losses. On a spreadsheet, this looked clever. In reality, the whole cake was sitting on rotten ingredients. Then the machine got greedier. Risky leftovers from mortgage bonds were repackaged into collateralized debt obligations, or CDOs. This was the magic trick. Take the scraps nobody wanted, rearrange them, and sell them as something new. But complexity did not make the risk disappear. It only made the risk harder to see. And when people cannot see risk, they do not demand enough return for taking it. That is when danger becomes mispriced. The next question was obvious. Who would convince the world these products were safe? That job fell to the credit rating agencies, Moody's, Standard & Poor's, and Fitch. They were supposed to be the adults in the room, but the business model was broken. The rating agencies were paid by the same Wall Street banks whose products they were rating. If they were too strict, the banks could simply take the deal to a competitor. That created a quiet pressure to say yes, a pressure to trust the models, a pressure to believe housing would not fall everywhere at once, and under that pressure, toxic mortgage products received AAA ratings. The AAA label mattered because it turned suspicion into permission. Pension funds could buy, banks could hold, insurance companies could invest. Foreign institutions could trust the product without reading every loan inside it. That is how American mortgage risk became global risk. A bad loan in Arizona could end up inside a security owned by a bank in Europe or a pension fund somewhere else. The poison was no longer local. While the world bought the story, a few outsiders started doing something almost nobody in the party wanted to do. They opened the boxes. They read the loan data. They checked the foundation. Michael Burry was one of them. He was not looking at glossy ratings or Wall Street sales decks. He was reading the actual mortgages, borrower by borrower, payment by payment, weakness by weakness. What he saw was terrifying. Many loans depended on borrowers refinancing before payments reset. But if home prices stopped rising, refinancing would disappear. The whole structure depended on the bubble continuing. Other skeptics, including Steve Eisman and Cornwall Capital, began seeing the same pattern. The market was not just expensive, it was fragile, and fragility is most dangerous when everyone mistakes it for strength. But knowing the house is burning is different from betting on the fire. To profit from the collapse, the skeptics needed a tool that could pay them if mortgage bonds failed. That tool was the credit default swap. A credit default swap worked like insurance on a bond. The skeptic paid premiums. If the bond survived, the premiums were lost. But if the bond collapsed, the payout could be enormous. Wall Street thought the trade was ridiculous. Housing always goes up, they believed. These skeptics were paying real money every month to bet against the American dream, so the banks happily sold them protection. But Wall Street did not stop with real mortgages. It created synthetic CDOs, products that could reference mortgage risk without needing new home loans. The same risk could be copied again and again. Imagine 10 different people buying insurance on the same burning house. The house is still one house, but the financial bets around it become much larger than the house itself. That was the hidden multiplier. Much of this insurance risk gathered around AIG, a massive global insurance company. AIG sold protection on enormous amounts of mortgage-linked assets, assuming the catastrophe was too unlikely to matter. That assumption was fatal. Finance has a cruel rule. The unlikely becomes deadly when enough people are exposed to it at the same time. AIG was not holding one match. It was sitting on a warehouse of gasoline. By 2006, the music started to slow. Interest rates had risen. Home prices stopped climbing in the same magical way. The escape route began closing for borrowers who needed refinancing to survive. Adjustable mortgage payments reset higher. The same house that looked affordable in the teaser period suddenly became impossible. Borrowers who were already stretched discovered that the real payment had been waiting in the shadows. Then home prices started falling. That destroyed the exit. If your house was worth less than your mortgage, you could not easily sell. You could not refinance. You were trapped inside the loan. Defaults rose. Foreclosures spread from street to street. Neighborhoods that had looked wealthy on paper suddenly showed the truth in red signs, empty windows, and silent driveways. Now the Wall Street products started breaking. Mortgage-backed securities lost value. CDOs cracked. Traders stared at screens and realized they did not know what these products were worth anymore. And when nobody knows what something is worth, nobody wants to buy it. That is how a liquidity crisis begins. Not with an explosion, with silence. No bids, no trust, no market. Bear Stearns was the first major warning. In March 2008, the 85-year-old investment bank ran out of confidence. Its rescue sale to JP Morgan was first announced at $2 a share. That price was not just embarrassing, it was a siren. But after Bear Stearns, Wall Street tried to convince itself the crisis was contained. Maybe Bear was weak. Maybe the worst was over. Maybe the system had survived the test. That kind of optimism was not analysis. It was denial. Lehman Brothers was drowning in real estate exposure, leverage, and assets nobody wanted to touch. The firm depended on short-term funding, which meant it needed confidence every day. Once confidence disappeared, time disappeared with it. Lehman tried to make itself look healthier through accounting maneuvers, like Repo 105, temporarily moving assets off the balance sheet. But moving the mess out of sight did not remove the mess. It only delayed the judgment. Then came Lehman's final weekend. Government officials, bankers, lawyers, and potential buyers gathered to search for a rescue. Barclays looked. Bank of America looked, but nobody wanted Lehman's toxic hole without protection. The government had helped arrange Bear Stearns' rescue months earlier, but rescuing Lehman was politically toxic. People were already angry about Wall Street. Officials faced a brutal question. Should taxpayers rescue a firm that helped create the fire? By Sunday night, the rescue failed. No buyer, no guarantee, no time. Lehman entered bankruptcy, and the market learned a terrifying lesson. Too big to fail still had one loophole. Sometimes the giant actually falls. The panic spread because Lehman was connected to everything. Hedge funds, banks, money markets, derivatives, short-term lenders. Nobody knew whether losses would appear next, so everyone pulled back at once. Then the reserve primary fund broke the buck after losses tied to Lehman debt. That mattered because money market funds were supposed to feel almost like cash. When even cash-like instruments became questionable, fear entered the plumbing. The next shock was AIG. The company that had sold protection on massive mortgage risk could not handle the claims. If AIG failed chaotically, the losses could blast through institutions across the world. At that moment, the crisis changed shape. It was no longer about bad mortgages. It was about whether the global financial system could survive the week. The heart of capitalism was beating irregularly. Banks stopped lending to each other. Short-term funding froze. Commercial paper markets seized up. Companies that had nothing to do with Wall Street gambling suddenly had trouble accessing ordinary funding. This is why financial plumbing matters. When credit flows normally, people barely notice it. When it clogs, businesses cut jobs, consumers pull back, and fear moves from trading floors into kitchen tables. The response was historic. Governments and central banks stepped in with emergency lending, guarantees, bailouts, and asset purchases. In the United States, Congress authorized the $700 billion TARP program to stabilize the banking system. AIG alone received a massive government rescue because officials believed its failure could detonate losses across the system. The argument was brutal. Save these institutions now or risk letting the entire economy collapse. But to ordinary people, the rescue looked like betrayal. Wall Street received lifelines. Main Street received foreclosure notices. Banks were stabilized. Families were told to tighten their belts. The system was saved, but trust was not. Unemployment eventually reached 10%. Millions of jobs vanished. Household wealth was crushed by trillions. For families, the crisis was not a chart. It was a moving truck, a pink slip, and a retirement account cut in half. The bailout debate created a wound that never fully healed. Many people understood the emergency logic, but emotionally it felt like the architects of the fire were rescued, while the people inside the burning building were left behind. Then came the question that still haunts the crisis. Who went to jail? After all the reckless lending, misleading ratings, broken incentives, and catastrophic risk-taking, criminal accountability at the top was almost non-existent. Kareem Serageldin became the rare senior Wall Street banker in the United States to serve prison time connected to the crisis. For many people, that became the final insult. The system collapsed, the public paid, and almost nobody at the top paid personally. Meanwhile, some investors who bet against the bubble made fortunes. John Paulson's fund made billions from the collapse. Michael Burry's bet became legendary. The people who read the data were mocked early, then proven right late. But this is not a simple hero story either. Betting against a broken system can make someone rich, but it does not undo the damage. Millions still lost homes. Millions still lost jobs. The scoreboard rewarded being right, not preventing the disaster. The anger did not stay economic. It became political. Occupy Wall Street and the Tea Party came from different directions, but both were fueled by a similar feeling. The game had been rigged, and ordinary people were left holding the bag. That may be the deepest legacy of 2008. It did not only destroy wealth, it destroyed faith. Faith in experts, regulators, ratings, politicians, banks, and the promise that if you worked hard, the system would protect you. The crisis revealed a brutal truth. Intelligence does not make a system safe when incentives are broken. In fact, smart people with bad incentives can make risk look safer, cleaner, and more profitable than it really is. The people building the products were not stupid. Many were brilliant. That was part of the danger. They knew how to model risk, rename risk, slice risk, insure risk, and sell risk, but nobody truly eliminated it. Lesson 1. Debt can create opportunity, but debt without discipline becomes a trap. A mortgage can build stability when the borrower can afford it. The same mortgage becomes a weapon when it is designed to fail later. Lesson 2. When people can sell risk to someone else, they often stop caring about quality. If the lender earns money when the loan closes, not when the loan performs, the incentive is already corrupted. Lesson 3. Ratings are not reality. A label can say AAA, while the underlying asset is rotting underneath. In finance, the sticker on the box matters less than what is actually inside the box. Lesson 4. Complexity is not protection. Sometimes complexity is the fog that hides the cliff. If an investment cannot be explained clearly, the danger may not be sophistication. The danger may be confusion. Lesson 5. When everyone says something can never happen, that is exactly when you should check the data. The most dangerous risk is not the risk everyone sees, it is the risk everyone agrees to ignore. After 2008, new rules came. Banks faced tougher capital requirements, stress tests, and more oversight. The system became more supervised, but regulation does not erase human nature. The hunger for yield, leverage, fees, and complexity never fully disappears. That is why 2008 still matters. Not because history repeats perfectly, but because incentives repeat quietly. The names change, the products change, the language changes, but the temptation to make money now and leave the risk for later never goes away. The world did not break because of one bad loan, one bad bank, or one bad trader. It broke because nearly everyone in the chain was paid to look away. Lenders, bankers, rating agencies, executives, investors, and sometimes regulators. And when the bill finally came due, it was not delivered only to Wall Street. It landed on workers, families, retirees, taxpayers, and people who had never heard the words mortgage-backed security, CDO, or credit default swap. So what do you think? Was the 2008 financial crisis caused by greed, bad regulation, broken incentives, or a system where everyone was paid not to ask questions? Drop your thoughts in the comments, hit subscribe, and I will see you in the next one. If you enjoyed the story of how the 2008 financial crisis broke the world, then you'll love the story of who really controls the world's money. Click the video on your screen now. I'll see you there.